Welcome back. My name's Chris Gosselin. Today we're talking to George Bory from Allspring Global Investment. George is out here from the States. Allspring has $650 billion in funds under management, of which well over $400 billion is in fixed income. And that's George's expertise. George, welcome.
Thank you, Chris. It's good to be here.
Nice to see you.
Yeah, and you.
Tell me a little bit about Allspring and your background and your approach to fixed income.
Yeah, well, Allspring is a global asset manager that has been around for a long time. We used to be part of Wells Fargo. Wells Fargo spun us out in a management-led buyout back in 2021. And we are now a totally independent global asset manager. We invest in the bond market, as you mentioned. We invest in equities, and we invest in cash, money market types of investments. We're an active manager. We're very proud of our active management heritage, and we invest in public markets. So we have a pretty straightforward product offering, but we do it well, and we stick to our knitting, and we're really looking forward to some exciting times.
Your objective in fixed income, from talking to you beforehand, is to provide a steady rate of return above inflation.
Yeah, I'd say from a bond investment perspective, bond investing is a unique type of investing. It's not equities and it's not cash. It's intended to generate steady, consistent cash flows. We're heavily dependent on coupons and interest rates to kind of drive returns in portfolios. The ultimate objective of any bond investor is to make sure those cash flows are consistent, they're persistent, and what we ideally want them to do is beat inflation over time. That's really kind of the hurdle rate, if you will. Now, different people define inflation differently, and there might be different objectives from an end investor, but a good bond manager can do that in different types of markets, different types of portfolios, and just deliver that consistent cash flow, that consistent income stream that so many investors all around the world are heavily dependent on.
And presumably you're trying to be as risk averse as possible.
Yeah, I would define it as that a good bond manager is risk aware. Our job is not to avoid risk, but to manage it. But it's critically important that we protect capital. As my first boss told me, it takes a lot of coupon payments to make up for lost principal. We're in it for protecting capital, capturing those income streams, that extra coupon, that extra interest rate that you're getting through time. We want to harvest that income and simply compound through time. So there's a very important risk awareness that a bond investor has to sort of pay attention to. It is different than other types of asset classes, but I wouldn't say it's risk averse. Like, we need to be risk aware, and it's our job to manage that risk as we move through time.
But you're geographically diversified as well.
Yeah,
right?
Yeah, we invest around the world. As I mentioned, we invest in tradable public markets. The lion's share of our assets are in developed markets with a pretty large percentage. Our portfolios kind of look very similar to what you see in the global bond market, where up to 2/3 of the market in some instances can be in the US. But we manage a wide range of portfolios that invest in different jurisdictions, different currencies, and different types of securities. So traditional government bonds, we'll invest in corporate bonds, both sort of a higher quality investment grade bond. We can invest in high yield, leverage loans, and also all different types of securitized products, from mortgage-backed securities to commercial mortgage-backed securities to different types of receivables like auto receivables or credit cards, and even today things like data centers and other types of industrial build-outs that create a revenue stream or a receivable stream, gets packaged up, put into a trust, issue bonds, and we invest in those types of bonds as well.
But critically, no private credit.
Critically, no private credit. That is correct. As I mentioned, Allspring is public markets only. We've been pretty clear that that's our competitive advantage. It's where our deepest skill set is, and we're very comfortable being in the public markets. It's where we do well, and it's really kind of sticking to our knitting.
George, let's we can't really avoid the situation in Iran at the current time and the way that has completely thrown markets. There's huge volatility and huge risk. What's your take on that?
Well, it's been a dramatic shock to both markets and governments and just people in general. You know, it was very much a surprise. When we look at investing for bond investors, we try to look through a very specific lens. Different factors are occurring all the time. When you have a big geopolitical shock or even a technological shock, any type of shock, the first thing we ask ourselves is, how is this going to affect monetary policy in different countries around the world? Will central banks need to respond to this shock? And in this particular case, the answer is not yet. You know, they're sort of, most central banks are kind of stuck on hold, waiting to see what happens. And then once sort of both the duration and the magnitude of the conflict kind of plays out, then central banks will start to perhaps react. But then secondly, the other sort of important consideration is, how does it affect inflation? And oil is the key linchpin. It's a major input to inflation all around the world. And obviously the conflict has pushed up oil prices pretty dramatically as we went from sort of like high 60s to 80 to 100 to 120. Obviously that's put a tremendous amount of concern into the market as it relates to inflation, at least in the near term. And so we've seen expectations for higher inflation move higher. What the market has yet to really price in is an extended period of inflation. And so as a bond investor, you know, I worry about inflation that can erode our spending power as we move through time. We've seen bond yields move higher as a result, but not dramatically. They've moved up higher, and but still very much in the range that we've been in for the last 12 to maybe as much as 18 months. And so the market is still, I think, in a bit of a wait and see kind of period, waiting to see how long and how significant this conflict it will become.
So that's the issue of price and inflation, or oil price and inflation. So even if prices steadied or you know, didn't cause huge inflation, is supply more of an issue for the world's economy, in your opinion?
So this is a supply side shock, and so that is a concern. Supply in markets and economies have difficult time adjusting to supply side shocks. We only have to look back to 2022 to look for evidence of that. And so I think there's a heightened sense of concern regarding that, but it's still unclear both the magnitude and the duration. And so from a supply perspective, if production of oil is constrained in Iran only, then other parts of the world can offset some of that. However, if it spreads and becomes more problematic for other oil producing countries, well, then supply will start to constrain. We are not at that point yet, but it is distinctly possible. But then, as you mentioned, with the Strait of Hormuz largely closed, it's the distribution of the supply, which is also, that seems to be a bigger concern than actual supply at this point in time. Very recently, it sounds as if that may start to open up, but you know, the longer that lasts, the more what doesn't matter if it's production or distribution, but folks are not getting the energy or oil or gas that they ultimately need. So supply shocks can be damaging to economies, especially if they last an extended period of time.
Can I just change tack a little bit? You've got congressional elections in the United States in November, and it's looking as if that may change things politically for President Trump. What's the effect of that going to be, do you think?
So it's very difficult to sort of forecast political outcomes, but we just look at the polls. There's a mixed view in the U.S. regarding both support for what's happening in the Middle East, and the more kind of close to home it becomes, the more controversial it becomes, and energy prices are the key link kind of into a lot of economies around the world, and so. There is concern, certainly, that high oil prices and some perhaps stagflationary outcomes could really change the dynamics as we go into the midterm election, which is not until November, so there's still quite a bit of time between now and then. But it does start to change the calculus, and we think the administration is looking at the polls and trying to assess, how much is too much and potentially how much, kind of volatility they're willing to absorb, to kind of achieve the geopolitical objectives while also maintaining their objectives back in the U.S. as well. So it's difficult to predict, but it will be a factor, especially if energy prices stay high and we start to see inflation pick up. That will start to affect people's opinions.
So all through that, what you do in your role and as Allspring is try to provide a risk-averse, attractive return with a steady monthly coupon. I mean, you've structured this through Bennelong in Australia, where there's a local feeder fund, which gives you good distribution. So from the Australian investor's perspective, this is still a good way of getting a steady return. It's currency hedged. Is that correct?
Yeah. No, that's correct. So from an investment perspective, the Allspring kind of view is that the backup in yields and the sort of the recent kind of move up in inflation expectations likely to be short-lived. And that is our basic expectation. And so as bond yields have moved up, we do believe this is an opportunity to add a little bit of duration or yield into portfolios. We would emphasize a little, not a lot, but that the longer term implications of energy spikes or energy increases, near term risk, inflation goes up, but then it does become somewhat of a tax on growth if it stays high, and then the sort of the downside of that is actually disinflation once you get through the inflationary spike. And so as bond investors, as those inflation expectations move higher, we want to kind of actually add a little risk into the portfolio, add a little bit of duration on the view that will start to come down as we get through the crisis, as energy prices come down and settle, and we sort of kind of move beyond the conflict. Now, there's always the risk that it lasts a lot longer than we expect. That is a possibility, but at this juncture, we want to, kind of add a little bit of duration to portfolios.
And with over 400 billion in funds under management, how do you move, or can you move quickly, or is this just sort of a bit like a big ship? How do you turn it?
Yeah, no, that's a great point. We have a wide range of strategies. So when I say add duration, that's a pretty broad statement across kind of a wide range of different types of investments. We pride ourselves on being nimble. We're kind of building our portfolios from the bottom up. We do a lot of security selection that goes into building these portfolios. It is a little bit like moving a tanker or a ship, but we're fairly nimble, and the market's big. We like to think we're big, but the market's much bigger than us, and so there's plenty of opportunity to use our size to our advantage. We're big enough to matter, so we can certainly help try to get excellent execution when it comes to buying securities, but we're small enough to move the portfolios around to be able to monetize or at least help add some value on that security selection decision. And duration decisions are just one small sort of what's one aspect to our investments. There's a wide range of other value enhancement things that bond managers do. It's strategic positioning and duration. It's different sector rotations, both internationally and within different types of sectors. And then there's the granularity of security selection. And what I've been told, and I think about this all the time, like, you're only as good as the bonds in your portfolio. I firmly believe that. And so you build a portfolio to deliver a certain type of income stream that you expect to use over time. Those bonds that go in there are so critically important, and the price will move up and down based on kind of that duration point that you pick. But the bonds that are in there, the companies, the governments, the different types of issuers, are the ones that are delivering those coupons into the portfolio. So it's critically important that we pick the right companies, and that's really the best thing that Allspring does. We have a tremendous research team. We have a really strong portfolio management team. You mentioned the whole risk component. I really want to stress risk aware, risk control. It's not risk avoidance. It is risk. It's risk management that goes into the portfolio, and when you do that, it's that consistency of cash flow that helps beat your benchmark and your references, but it's really delivering to the client that consistency of cash flow that they need for their pensions, for their insurance liabilities, or just their individual daily lives. That's what bonds do.
So it's managing risk rather than avoiding risk.
Correct, absolutely.
George, I've been delighted to meet you. Nice to talk to you. We'll look forward to seeing you out here again soon.
Chris, thank you for having me.